Here, big day for you. Bank of America reporting its most profitable first half of the year, except for 2021 when there were large reserve releases. Higher for longer rates, clearly a big tailwind for you and your banking peers. You have some of the lowest funding costs out there, though, and loan demand has really been steady. What's the competitive dynamic right now with regard to deposits and loans right now, and how is that impacting your pricing decisions moving forward?
Well, Leslie, first, thank you for having me. And I just want to thank, I've got 200,000 plus teammates who do a great job of customer, and that's our key competitive advantage. And they bring in loans and deposits and fees and trade well. And so if you think about what's going on now, obviously, as the rates for excess cash people don't need to run their household, became more competitive, those went into market. And frankly, that's what some of our wealth management flows or our Merrill Edge flows are putting those deposits in the market. But the important thing is we have a huge amount, $9 trillion of deposits, and those deposits are very stable, and they represent a dominant part of the money that people move to conduct their daily lives, and therefore they're very low cost because that money is always in motion. If they're trying to get yield on money, they take it and put it in direct treasury holdings and money market funds, and we do that for them. So our competitive dynamic is different than other people's who are more CD funded and use deposits as core funding. We have $1.8 trillion of deposits, and we have $1.04 trillion of loans, and that difference is excess, and it really represents people's money who's in motion and conducting their daily lives.
Speaking of money and motions, consumers clearly seem to be spending here. Growth in line with inflation for credit and debit card spending during the quarter. We did see that softer CPI print. I know inflation had been a headwind for consumer spending, in the past, but that seems to be abating a bit. Still, credit card loss rates were up about 40 basis points quarter over quarter, although still below those pre-pandemic levels. So, I'm just curious kind of how you'd characterize the health of the consumer at this point. How much do they have left in those excess savings that you were describing a bit ago?
So let's sort out two things. From a credit cost standpoint, you're seeing the activities of consumers move back to where they were. But everybody talks about we're normalizing to 2019 pre-pandemic. People have to realize for our company, the 2019 charge-off rate was probably a 40 or 50-year low. And so we are at levels that are very low credit risk, very low credit costs. And we were doing $1 billion of provision a quarter back then. And, we're doing a little bit more than that now, et cetera, given a recession predicted ahead of us. So, the normalization is pretty good times in the banking system. But let's broaden back out. If you think about the U.S. consumer, what we see with the 60-plus million consumers we have is the rate of their spending, not only their debit and credit cards, which is the 3% you mentioned, but across all the ways they put money out every day, is growing at about a 5% rate through the second quarter, and frankly about the same rate for the first half of July here, which is half the rate it was growing, last quarter or end of last year over the year prior quarter or year. Now that's showing that the consumer is more in line with the low inflation, lower growth economies that were there in 16, 17, 18, 19 when the Fed raised rates and inflation was low. And so that gives me a view that inflation is getting under control. And you saw that in the spending numbers today, that you see that in some of the inflation numbers over the last few weeks. And that's good, because in the end of the day, it'd be great if we could get this inflation tamed and still have this kind of unemployment at 3.7% or whatever the unemployment rate is. That is marvelous. We'd have an unemployment-less slowdown, which would be a fantastic outcome. So the consumers are spending, they're employed, they're earning more money, and they do have a lot of money in their accounts left over. The question is, if times get tougher, will there be less employment, more unemployment? Will there be more layoffs and things like that? Right now, the activity that's taken place so far has been absorbed by the economy, and we'll have to see that happen. Remember, our team, the Candace Browning-Platt and the team lead, our research team, which is terrific, still has us having a slight recession in the early part of 24, but they have moved that out again, reduced it to 2 quarters, not 3, and lessened the depth of it to basically a soft landing, more or less 1% down in 1 quarter, 0.5% down the other quarter. So they've continued to get more, less conservative, right, whatever the word be, on the future recession. But they still have a recession predicted.